Hey everyone, and welcome back to FinEd, your favorite financial education channel. This video came about because of a comment received on a video we posted last year titled How a South African is Taxed When Earning a Foreign Income. In this video, we will be diving into Section 10, Subsection 1, Paragraph GC, Subparagraph 2 of the Income Tax Act on how foreign pensions are taxed in South Africa. But before we begin, please don't forget to hit that subscribe button to stay up to date with all of our latest content. Now, let's dive right in. Section 10, Subsection 1, Paragraph GC, Subparagraph 2 of the Income Tax Act provides an exemption from regular taxation for any lump sum, pension, or annuity received or accrued by a resident from a source outside the Republic of South Africa, specifically in recognition of past employment conducted outside the country. It's important to note that this exemption doesn't extend to lump sums, pensions, or annuities obtained from a local retirement fund or insurer unless a portion related to foreign services rendered is transferred to the local retirement fund or insurer from a source outside South Africa for that particular member. The term past employment outside the Republic of South Africa specifically pertains to foreign services or employment. Only the portion of the lump sum pension or annuity directly related to these foreign services is eligible for exemption from normal tax. Any amounts not associated with foreign services do not qualify for this exemption. When we talk about past employment outside the Republic of South Africa, we're referring to work you did in another country. If you receive a lump sum pension or annuity as a result of that work, only the part of the money directly related to your overseas work is tax-free. Any money not connected to your foreign work is subject to taxes. Now, the term sources outside the Republic of South Africa is like the place where your money comes from. In the legal case CIR versus Lever Brothers and Unilever Limited, they said it's not just about where the money is from, but it's more about the actual work you did to earn that money. So if you worked in South Africa, your money source is South Africa. If you worked in different countries, then each country is considered a source. This means we need to figure out how much money comes from each place you worked. So when we say source outside the Republic in the tax law, we mean the original place where you worked to earn that lump sum pension or annuity. To calculate how much of your lump sum pension or annuity is tax-free because of your work outside South Africa, SARS use a formula based on the time you spent working in different places. This way, you get a fair exemption for the money you earned abroad. This is the formula: foreign services rendered divided by the total services rendered multiplied by the total amount received or accrued. Now, let's use an example to drive the message home. Let's use Tato as an example to explain the situation in simpler terms. Here's the scenario. Tato lives in South Africa and worked for a company in another country from 1992 to 2019. While working there, Tato was part of the company's retirement fund. In 2019, after working for 27 years, Tato retired and got a lump sum of 1.2 million rand and a monthly pension of 45,000 rand. During the working years, Tato spent 9 years working in South Africa and 18 years working in the foreign country. Even though retirement happened in South Africa, Tato still kept a connection with the foreign retirement fund. For simplicity, were not considering things like double tax treaties or exchange rates in this example. So what is the outcome? Tato, being a resident of South Africa, received money, which is a lump sum and a monthly pension, from the foreign country where Tato worked. This money is a reward for the work done outside South Africa. So, Tato gets a special exemption from regular taxes on this money. To figure out how much is exempt, they use a formula. SARS will use a formula based on the time spent working in South Africa and the foreign country. It's a way to make sure Tato gets a fair break on the money earned abroad. Therefore, we need to apply the formula. So it's foreign services rendered divided by total services rendered multiplied by the total amount received or accrued. In this case, it's 18 years divided by 27 years multiplied by 1.2 million rand. And we get the answer of 800,000. So out of the total lump sum Tato got, which was 1.2 million, 800,000 rand doesn't have to be taxed in South Africa. Let's go to example number 2 to show exemption for amounts received by or accrued to a resident from a local retirement fund with a foreign fund transfer. Let's meet Hendrik. Hendrik is a South African resident who worked for a multinational company from 1994 to 2019. For the first 20 years, Hendrik contributed to the company's foreign fund. In 2014, Hendrik decided to stay in South Africa and transferred the entire value of 15 million rand from the foreign fund to the employer's local retirement fund. During these 20 years, Hendrik worked 15 years outside South Africa and 5 years in the country. Hendrik eventually retires in 2019, and the retirement fund's value is 27 million rand. Hendrik decides to take 9 million rand as a lump sum and the remaining 18 million rand as a monthly pension of 90,000 rand. Now, let's calculate the lump sum. Step 1. Determine the portion of the lump sum related to the transfer from the foreign fund to the local fund. And we're going to apply this formula. The amount transferred divided by the total retirement interest multiplied by the received or accrued amount. So in this case, we take 15 million rand divided by 27 million rand multiplied by the 9 million rand, and we get an answer of 5 million rand. This means that 5 million rand of the lump sum is attributable to the amount transferred from the foreign fund to the local retirement fund. Step 2, we need to calculate only the portion of the amount transferred that relates to foreign services will qualify for the exemption, and we apply the first formula that we did in the first example. So we say foreign services rendered divided by total services rendered multiplied by the amount calculated in step 1. So we go 15 years divided by 20 years multiplied by 5 million rand, and we get 750,000 rand. So in this scenario, 3.75 million rand of the lump sum is considered exempt from normal tax in South Africa. The remaining 5.25 million, how did we get that? 9 million minus the 3.75 million will be subject to tax according to the applicable rates for retirement fund lump sum benefits. Even though South African tax residents are taxed on all the money they earn globally, there are some situations where you might not have to pay tax on certain amounts. These are called exemptions. It's crucial for taxpayers to be aware of these exemptions and make sure to claim them if they qualify. However, here's the important part. Just because a certain amount is exempt from taxes doesn't mean you can keep it a secret from the South African Revenue Services, SARS. You still have to tell SARS about the full amount you earned, including the exempt portion, when you submit your tax return. The exemptions will be taken into account, but being fully open about your income is still a must. So, even if some money is exempt, you need to let SARS know about it. Full disclosure is a requirement to stay in line with tax rules. In conclusion, we learned that certain portions of lump sums, pensions, or annuities can be exempt from normal tax, particularly when linked to foreign services. While South African tax residents are generally taxed on global income, exemptions exist, emphasizing the importance of awareness and proper claiming. Remember, even if you qualify for an exemption, it doesn't mean you can keep it off the radar. Full disclosure to SARS is mandatory when submitting your tax return. For personalized advice and a deeper understanding of your unique situation, it's always wise to consult with a qualified tax planner. They can provide insights tailored to your circumstances, ensuring you make the most of available exemptions while staying tax compliant. Thank you so much for viewing the video. I hope you found it helpful, and if you have found it helpful, please leave a thumbs up and stay informed, claim what's rightfully yours, and be a tax smart resident. This is Finette signing off. See you in the next video.